What's up, everybody? Michael Silva here. You're watching the Stock Market Brief Show. Holy moly, what a bounce that took place today as the NASDAQ composite hit into correction territory from peak to trough down 10%. We're going to look into a couple of charts today, map out some key levels. Let's get into the show. All right, everybody, welcome back. We are just taking a look at the S&P 100 advancers and decliners today. So we had 50 advancing stocks and 51 declining. The reason why I'm showing this is simply just to show, one, we had obviously more capital flowing into the advancing stocks, so that's a positive sign. But earlier in the day, what was interesting was there was actually significant more amount of stocks that were underperforming. And then all of a sudden, we started to get in some pops of green as the market started to turn around. If you take a look at the heat map of the S&P 500, there's still quite a lot of red around the board, but you can see that the big names made their comeback. So Microsoft started off down pretty big. Apple started off down pretty big. But you can see now that they're pretty gray, which means that they finished relatively flat. So they made up a lot of those losses. Google in the green, Adobe in the green, NVIDIA in the green, Tesla, pretty bright green there too as well. Amazon tried to put out a really nice hammer candle for the day, but it ended up down, but still recovered from the early midday market bottom. And, it just question on everyone's mind, is this where we're going to rally to all-time highs? And, we talked a lot about the weekly risk ranges, and we're going to follow up on that in today's video. But let's first take a look at the 11 sectors in the S&P 500. Really, the only one that stood out today was healthcare. That was up 1% for the day. Technology was relatively flat, but that was also towards the very bottom of the list intraday. So that comeback was very, very powerful. Another thing to point out here, just on the left-hand side, is the indices. You can see pretty flat across the board. So, if you're not looking at the candles per day or, intraday, and you just look at the end of day, you look at this and you're like, nothing really happened. But as we know, if you are looking at the charts intraday, there was quite a bit of stuff that took place and a lot of opportunities that took place intraday too as well. Interestingly enough, healthcare, earlier throughout the day, biotech, one was the top performer right there, up 1.41%. But intraday, I was noticing that IBB has just been getting completely obliterated. This is just a iShares NASDAQ Biotech ETF, and this thing is coming from 177.50. So this thing is getting completely hammered. And as the market was pressing down towards the earlier in the day, I noticed that I was like, okay, I'm going to pull this up on a 15-minute chart. And when I did so, I can see all of these positive divergences forming, falling wedge, positive divergence, still under this. And, when things get too overextended like this, it typically sets up for bounces. And you can see here, that's the same exact chart, but we had that positive divergence, falling wedge, and it broke right out along with all the other stocks. So a lot of stocks kind of found their bottom at really the same time. If we take a look at the NASDAQ Composite Health Dashboard, and the reason why I'm showing the bounces, by the way, is when we get bounces like this, we don't know if they're going to be sustained or not, because a lot of these moves, for example, just IBB for the example, it's still under a declining 5-day moving average as RSI is getting pretty crisp. And we'll see that theme throughout the indices on those 15-minute timeframes too. But if we take a look here, you can see from peak to trough down 10.5%. And we bounced from there. So that is correction territory. So you have to wonder, okay, we came into the 200-day moving average on the NASDAQ composite. It was around 10% correction. That shows an opportunity for people to potentially step in, cover shorts, could be covering, it could be, dip buyers. It's a combination of both. But if you pay attention, we came back and closed kind of pretty much exactly where we were yesterday, just up slightly back into this range. So one has to wonder, okay, is this the start of a bear market? Are we going to continue to head low? We're just going to have a little bit of a bounce. Well, that's yet to be seen. I will point out that these lows have been just constantly building up, and we've been showing, the termites eating the foundation of the NASDAQ composite, the percent of stocks above the 200-day moving average. That thing's been getting pretty obliterated too as well. So yes, it was a strong day, a good bounce, and that's what we've been seeing. That's what we've been talking about, potential bounces coming, but just still don't we can bounce right out to all-time highs. That's totally fine, but it doesn't mean we're out of the woods. So don't treat it as we're out of the woods, because there's still a whole lot of volatility packed within these indices. All right, so if we take a look here at a couple health indicators over here, you can see the relative strength line between the Nasdaq and the Nasdaq Composite and the S&P 500. That's still trending below the 50-period moving average, and the advanced decline line, it's just been completely obliterated here too as well. And then meanwhile, the NAMO had pointed down a little bit lower today, still below zero. It's a lot better when this thing is obviously pointing up and above zero to get some breadth into the market. Now, can we potentially see more of a bounce? Well, it's going to really depend on these yields, right? We need to see the 10-year yield back off a little bit to see potentially some relief rally in tech. And we've been paying attention to this chart here. You know, it's been expanding and then now they're contracting, and we can see that here on the spreads, the 10 and 235. You can see the 30 and 5 pointed down slightly today. The 10 and 2s remains relatively flat. When this starts curling over and heading down, it's not that great for financials. Where financials today, you know, if you were watching intraday, they started up higher, but then obviously they gapped up, and you saw some weakness, some people fading into that, which was something that we were anticipating. Now, there's a lot of talk about the Fed raising rates, and you know, I think it's going to come. I think we're going to get some rate hikes, and one way to easily kind of point that out is if you just look at the 2-year. The 2-year has been flying up, and the 2-year has always been a pretty decent indicator for when the Fed is going to, not when, but that the Fed will typically raise rates. And I can show you this. If you just look at this gray shaded area, that's the Fed's fund rate, and the black line, the thin black line, is the 2-year Treasury yield that we just previously saw from the other previous chart. And what you'll notice is typically the 2-year yield moves up before the Fed fund rate, and it typically moves down before the Fed fund rate. You see right here, moves up, moves up, moves up, moves up, moves up, then this moves up, and now, you know, and this same thing moves up, and then this moved up. But now take a look down here, like we're ripping, completely ripping to the upside. So, you know, are they going to respond? Are they going to start lifting rates up? Is this correlation going to hold? I would imagine so, as they're saying right now. You know, 3 rate hikes are coming, potentially 4 or more. You know, our news feed is actually just getting painted with all kinds of, you know, like Jamie Dimon, she's the best economic growth in decades. More than 4 rate hikes this year. 3 rate hikes won't do it. You know, it's just a bunch of just in your face news coming out, right? So it's a lot of noise, and you have to wonder, like, they do seem serious about tapering and raising rates, but if we start to see growth decline, how is the Fed going to raise rates into an environment with declining growth? And if they do that, I mean, hold on, like, tight, because it's going to be a really rough environment if that's actually the case. So it's going to be, you know, is the Fed put? Is it going to be lowered? Are they going to respond to a 10% correction or 20% correction, or could it be potentially even bigger or deeper in these markets? And that, to me, you know, just spells out more volatility. What we've been seeing the market very confused, up, down, up, down, up, down, expanding ranges, and so forth. So still, you need to be very careful. Absolutely, 100% very careful. If you take a look at the 10-year yield, a little bit of a shooting star type candle as the 10-year yield has been getting pretty darn frothy, but it still ended up on the day, right? But it started to back off intraday. So where did we close at? We closed at the last, where's the high? Where's the close? Oh, there it is, 1.78. So, geez, you know, we had another high, 1.808, and today we close obviously slightly higher, but you know, it's been such a rapid move. I would imagine this has to take a little bit of a breather, which can really help to that bounce that we previously saw. So intraday, this moved down, and you can see that when it was moving down on an intraday basis, you did see some relief, obviously, in the markets. If you take a look at TLT, it's still within this trading range. My position's still on. I didn't get stopped out. Nice piercing pattern type candle. So if the 10-year yield wants to back off a little bit, this can rise, and that, you know, that'd be a pretty decent trade. I'm just playing it to the middle of the range. I'm not doing anything that aggressive, you know, but that's just kind of what I'm watching for. Maybe I'll remove 50% off mid of the range. That's 146 to 147. If it keeps continuing to go up, okay, cool. Then I'll remove the remainder. But that's just kind of what I'm doing as far as a range trade there. Just to have some exposure. And, you know, another thing to point out, obviously, we've been talking about growth and value's been outperforming growth, obviously, from a relative standpoint. And this happens when we see, like, the yields rise. So you can see right here, bam, okay, the relative strength between growth and value, it's been heading down And you can see the 10-year yield, obviously, we talked about this on the previous market brief, going straight up. So when the 10-year yield rises like this, you typically have your growth stocks, your mega cap growths, they get suffocated, right? They sell off. Now, from a relative standpoint, I think people might be getting confused here. This is a relative strength. So even if value goes down and growth goes down in this environment, I'm basically saying that value, so IWD, for example, or other value funds, this would just perform better from a relative standpoint. So this could still go down. IWF, which is growth, that can still go down, but it'll go down more than IWD, and that's what causes the line to drop. It doesn't necessarily mean if IWF goes up, IWD goes down. Okay, that's not what the relative strength line means. It means from a relative standpoint, which one's performing better. That's what that means, okay? And as we see right here, it is still getting overextended, a little bit of an uptick today. So if the 10-year yield backs off, I would imagine that this thing could start turning back up and through this, which would lend to that tech rally and or bounce, which we need to pay very close attention to, which we'll get into those charts now. Let's look at the weekly ranges. All right, let's take a look here at the S&P 500. So we posted this chart on the previous video. These were the weekly ranges. I just want to show you how powerful these have been acting. Bam. You can see right here, we came right into it. If you're on my Discord, you saw me post that intraday a little bit late, right around there at 460-ish range, I think. And then we just rallied right from that area. Where did we close? We closed right on the 50-day moving average, right back there, still down slightly on the day, okay? Big volume, big hammer candle, big area of support, not out of the woods yet. That's why I've been saying there's no real trade setups right here. We need to see some consolidation. The only trades that I'm seeing are either these little gap fills on various stocks, or you're playing a range. So it comes down to the low end of range, you buy, even though there's a lot of fear and panic, and then you try to play to the middle of the range or the top of the range. That's all I've been watching so far. Until breakout trades start to work again. And what I mean by breakout trades is there's a lot of good setups. There's stocks with the 250-day moving average sloping up like this, even 150-day, so all in line. And then you have the price. Let's just draw black. It comes like this, boom, boom, and then it starts getting really tied up in this area where you start to have a breakout, but it breaks out and comes right back in. And it's like, okay, it's obviously that environment is still not working for breakouts. So once again, you just need to be very careful there. If you take a look at the VIX shot up. Where did it land? It landed right there, filled this gap, this little white box right there, and then we started backing off. We still have one gap below us. We have these two gaps still above us. So that's what we need to watch out for. Okay, continue on. This is the Qs, okay? The Qs, obviously we're in this trading range, and then the market priced in from 390 down to 370. That was the previous chart that we showed. Where did it go? Bam, zoom in. Tagged the lower range, and it acted as support. That's not always the case. These ranges aren't meant to be support and resistance. It's just to give us an idea where the market is pricing in, where they'll potentially close. The options will expire within here around 70% of the time. They've been acting as support and resistance, and they give us good ideas for potential fade trades. So if it comes down here, you'd be like, okay, it's only Monday. Chances are, if it gets way outside, then there's going to be new hedging that takes place, and it can really perpetuate itself down. But one day in and you're already moving down this on an overextended move, it's like, okay, I feel pretty safe entering in right here from a long position, and from a risk to reward standpoint. And this one obviously ripped right back up and came right back in this range. So that's positive. This looks like it can have some follow through, but just be mindful that where's it going to follow through to? Is it going to follow right up to all-time highs? It's going to be an easy peasy? Maybe. But also, we're still below the 20, below the 50 moving averages. So, if we come back up, that's the upper range. Maybe we can hit the upper range. But just be mindful that right there is pretty much in the center of this trading range. So, bam. Okay? A lot of the times what you'll see happen is it'll come up to a range or below to a range, and it'll just doodle around. That was, I think, last week was pretty much like that. All right, let's continue on. This is interesting to me. The BPNDX chart, positive divergence. There it is. That's typically a good opportunity to potentially go long. So that also kind of leads, okay, the 10-year yields are getting a little overextended. We're getting some overextended readings here. We're moving into support. We're starting to see some strength. That all lends its hand to a potential bounce in growth in tech. Okay, IWM, this is what the chart looked like. Where did we end up? Bam, huge hammer candle. Like, look at that. It was a big, huge red candle. All this fear, oh my gosh, so many articles at this point right here came out, basically just, blood red, things are falling apart. And then all of a sudden it came back and they're like celebrating. It's like, all you have to do is just look at these ranges. And if it comes down here in a single day, you'll have that extra added protection in your head, in your mind, to know that, like, okay, nothing actually out of the normal is happening. Because last Friday you can look into this and you'd be like, oh, well, actually this is pretty normal. It's acting how it's supposed to act. That's exactly what it's doing. That's exactly what the options market priced in. That's where we are. Okay. Dow Jones looked like this. Where did we end up? We almost tagged the lower range, tagged the 50-day. This one did finish down. Actually, I think that Dow Jones was the laggard of the bunch today. Let me see here. Yeah, down 0.5%. It was the laggard of the bunch overall. And you could see here, but it's also been the top performer, so it's backing off slightly there today. But a huge hammer candle, right? Tagged the 50-day, tagged around the lower range, closed back above the 20-day moving average. But as you can see, look at the range of the candles. That's what I want you to pay attention to. The range of these candles. They're big from a relative standpoint to all these other little ones. So a big range from high to low, it just tells me that there's still a lot of volatility. And remember, volatility is both up and down. So just because we had this bounce, we can come right back up here, but that doesn't necessarily mean we're still out of the water, right? Or we can come right back down here and close within this area. Heck, we can even get below that and we can see some more sell side, but the hammer candle doesn't really quite suggest that. Just looking at the volume as it came into a previous area of support. So big volume, big hammer candle into a previous area of support, plus that lower range, 50-day. So yeah, it looks like we can actually have some sort of follow through, but just be careful, obviously, in this environment. Let's look at a couple 15-minute time frames just to get a good idea too, why I'm a little hesitant on the bounce, why we just need to be a little cautious. And by the way, I did take positions on this bounce, just to be clear. But I'm also took them from a very a high risk to reward standpoint, which I'm doing just fine with now. So even if they were just basically, if I get stopped out of it, it'll be a break-even trade now. But let me show you here. From a 15-minute perspective, we're below the 5-day moving average, and short-term it's declining. This was a really strong rally, okay? And you can see here we rallied right back into these previous areas and levels that I mapped out. We're at right around 466. So what can you potentially watch for? Well, if this continues to go up, look for that 61.8% retracement level. I put on some retracement levels just to get a good idea of maybe some key levels just to pay attention to. That 5-day moving average is declining. By the time it opens, we'll see if we gap up or gap down, but this can end up right by the 50-day. Okay, so just be mindful. There's an area of resistance right there, and then we kind of squabbled around in here, came down, it acted clearly a couple of times here. So this zone in here could be a potential profit zone or an area to short into. Now, if we start getting above that, okay, that clears the sky to potentially hit this volume shelf profile up here at 478. All right, so that's what I'm kind of keeping an eye on going into tomorrow, which I'll probably honestly keep relatively light trading day because I have my positions on now. If we take a look at the Qs, obviously, too, just look at how strong of a move that is. RSI is coming up, not quite overextended yet. This is trying to get back above zero. Start to look at that 5-day moving average. Okay, it's declining. So we're seeing some volatility. Boom, 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 boom. All right. This, you don't want to chase this stuff because it could come down, could slow itself down, and then, build a base here. And then that would be, to me, a lot better. So if this 5-day moving average started coming down, this came up, we came back down, maybe chopped around, but then started to build up, that to me would be way better of a trade versus just jumping into it, coming up and then maybe coming down, and it needs to consolidate. It just has to happen. So what happens here if we get up to around this level on the high end, 392? Just keep an eye out on that 392 level coming into tomorrow. Will it reach there? That's a pretty large move. That's I don't think it's going to reach there by tomorrow, but you never know. That was a big move from 370 to 380, so perhaps we do. If it goes to that 392, let me go back to the Q chart here. Yeah, look at that, 390, boom. That's the upper range. So yeah, be very mindful of the upper range right there. So 390, Did I get that right? Yeah, and come back to this chart, the Qs. Yeah, it's slightly below that, so 390, 392. So this zone in here, that's the upper expected move. So if this starts ripping up into there, yeah, be mindful. If you're in some long positions and you haven't taken profits, and it comes straight up into there, yeah, consider taking some profits, locking in some gains, moving up your stop loss, doing something like that. Take a look at the DIA. Also, very strong move up. Nothing different there, but we're still below that 5-day moving average, okay? IWM, I didn't actually put in the fib retracement here because really I just wanted to call out the range. Bam, we're just still trading within this range here, the shorter term range, and you can see the 5-day moving average. It's declining short term, but it's rather neutral. So can it come back up right here to around 220? Absolutely. If it ggets up there very strong, it'll probably back off. So what you want to see is something slowly build and then go backwards. No, go slowly build and start to do something like that. But we'll see here. We'll see what comes into tomorrow intraday. Let's hop into crypto really quick before I wrap up into the conclusion section. First off, Bitcoin to gold ratio, Sailor to shift ratio started to turn up again. You can see the price of Bitcoin putting in a little bit of a hammer candle, all positive right there. Another thing to call out too, if you're bullish crypto, this is good so far. Look at that. A low and a higher low, a low and a lower low. What's that mean? It's a positive divergence on the rate of change. Yes, that's what you want to see, especially now. That's really good if this starts crossing back up through zero. It doesn't mean that we're going to rally up to all-time highs or anything, but at least it increases a shot, right? It gives us a better opportunity as we've seen previously. So if that's the case, what you can start looking at are one, crypto, Ethereum, right? Bitcoin, or stuff like MARA, all right, Mara, Hut, Hive, what else is there? BT, I think was one, BTF. There's all kinds of them. All right, so keep your eye open. Bitto, the list goes on. So potentially crypto equities. Let's go down to Bitcoin. So Bitcoin, you can see here that hammer candle, right? It was a little bit of a explosive move to the downside, and then we came back up. So maybe that was the capitulation candle. But we're not out of the woods yet. We're still below that 44,000. Like I said, we're still below key moving averages and below that 44,000. So sometimes you get these undercuts, boom, and then you could potentially rip up. Now, what was the level that we talked about in the previous video? 40,000. What did we found support? We found it right there at about 40,000, came just below that. So pretty darn spot on there, which is good. Ethereum, actually, let me go back to Bitcoin really quick. I want to point out this. Bitcoin still underperforming the S&P 500. I would like to see that turn up and get back above that 50-period moving average. Okay, that's also something I'm paying close attention to. Ethereum below the 200-day moving average, just like Bitcoin. I would like to see this obviously turn back up and go through this. This one doesn't look as good on the chart, but we'll see, because if the if they do start rallying, this could be a strong performer too as well. You can see here on the RSI, it is getting a little bit overextended to the downside. This is where breakdowns occur, obviously, and where, also bounces potentially happen. So just because we can get a bounce doesn't mean we're out of the woods, right? So if you go long and you catch a move and you're like, yes, and then it comes right back down, right? It's never a good experience. So just be mindful of all of that. And what we can do to be mindful is just pay attention to those indicators that we have to see if they continue to turn up, or if we start getting more relative strength from an S&P 500 perspective too. Okay. All right, everybody, that's all I got for you. Went a little bit longer than I wanted to do. Hope that helped out. There's some key levels that we kind of went over. This is kind of my thought process going into tomorrow and the rest of the week is, high alert. Obviously, this is a nice bounce. It looks like it's setting up for a nice move. 10-year yield backs up. It makes sense to see maybe potentially, a little bit of relief in those big names, growth names, as well. But we're just not out of the woods yet, right? The composite hit down to 10%. And then all of a sudden we started moving up higher from that 200-day moving average. There's obviously still a lot of volatility packed in all of this stuff. You can see that through the ranges of the candles. So once again, just navigate this environment from a tactical perspective as best as you can, given the current context of the market. That's all I got for you, everybody. Have a good night.